Hi everyone, we're here in college accounting. We're looking at Chapter 5, Cash Control Systems, and in this segment we are going to specifically focus on Section 5-3 in our notes and journalizing dishonored checks, electronic banking, and how we handle electronic banking transactions. So, first, let's have a little discussion about what we call a dishonored check. This is just basically what a check is that we typically think of as a bounced check. It's a check that the bank basically refuses to pay, typically because there's not enough money in the account of the issuer of the check. It's recorded on our check stub, and we write down under the other section that we've got a dishonored check and the amount that is going to be included in the dishonored amount, and we take the subtotal or the balance brought forward and we subtract that amount out of our account. Because if you think about it, what you have when you have a dishonored check is you have a check that you received from, let's say, a customer. You have a check that you've received from a customer for a certain dollar amount. And what you have done is you've taken that check in as if it was cash and that you received cash. But when the check bounces, now you've got to back that cash back out of your account because you never really did receive it. So that's the process that we're going to be talking about in this segment. So we write the amount of the dishonored check on the line titled Other, and then we write the amount of the dishonored check in the amount column, and then we calculate by subtracting the dishonored check amount and taking it back out of our bank records in our check stub. Then we have to record this dishonored check in our journal so then it can later be posted to our cash account in our general ledger. So if we were to say that we had a dishonored check that was received on November 29th, that we received notice from the bank of the dishonored check from Campus Internet Cafe. The amount of the check was for $70, but now we also have to record a fee of $35 because the bank is going to charge us a fee for that dishonored check. So now, we don't want to be out $35. That's bad business practice. So what we've got to do is we've got to charge back the amount of $35 and the amount that Campus Internet Cafe originally wrote the check for, the $70, and we've got a total of $105 that Campus Internet Cafe now actually owes us. So they owe us the amount of the check that they originally wrote that was bounced, and they owe us the amount of the bank fee that our bank is charging to us. So, and we record that on a memorandum as our document source. So this is what it's going to look like from a journal entry standpoint. On November 29th, we have created an account receivable because they now owe us that. And we created an account receivable from Campus Internet Cafe, and we documented that on on Memorandum 55, and that's our document source. And we have a debit for $105 to the account receivable, and we have a credit of cash to the tune of $105. And that is the whole process of journalizing a dishonored check. The only piece that would be left would be to post those two amounts to the general ledger balances for the account receivable and the general ledger balance for cash, to make sure that those balances got reflected in those accounts, showing that our balance of our cash went down by $105, and now Campus Internet Cafe owes us $105. So, how do we handle transactions involving electronic funds transfer? First of all, an electronic funds transfer is just a computerized cash payment system transferring funds from one account to another without using check or cash or any other form of currency. It can be done by phone or computer, and in today's day and age, this is very common. Probably many of you have seen your parents pay their bills using electronic funds transfer. Well, when you have electronic funds transfer, you still have to make sure you record that transaction in your journal, and then that transaction gets posted to your ledger. You also have to record that transaction in your bank register, in your bank checking account book. So, if we have a transaction on September 2nd where we paid cash on account to Kelson Enterprises for $350 and we used electronic funds transfer, we would, instead of writing a check, we would be using a memorandum, and in this case memorandum number 10, to reflect that transaction. The rest of the transaction pretty much looks the same as when we would use a check. We're paying down on our account to Kelson Enterprises, and we're writing it on memorandum 10 for $350, and then we're going to credit our cash for $350 to show that our cash balance is going down by that amount. Similar to that is a debit card transaction. When we take money out of the bank using a debit card, whether we're making purchases or just taking money out of our account for cash to use in the business, we still have to record that use of our cash and reflect that in our bank account, and we have to reflect that in our general journal and then update it and post it into our ledger. So if we were to have a transaction where we paid for supplies on September 5th using our debit card, we would record it on a memorandum as well, and we would record the date and the account supplies, and instead of writing a check, we would record it on memorandum, in this case memorandum 12, and then what we would do is a debit for our supplies that we were purchasing, and we would again now do a credit for cash to show that our cash is going down by that $24 that we used the debit card for the purchases. And that concludes section 5-3 for chapter 5. Thank you for paying attention, and we'll see you in class.